Good afternoon, everybody. Welcome. I'm Stacey Ward, the Director of Data and Content here at CAP HPI. I'm delighted to be hosting today's session. Thank you very much for joining our CAP HPI Market Review webinar. These sessions form part of our ongoing commitment to keep you fully up to date with the latest market insights, as well as the work and activity that's going on here at CAP HPI. We really appreciate you taking the time to be with us today. There has been a slight change to the public speaker lineup. So today you'll be hearing from Matt Freeman, our senior management consultant, who will be taking a look at how BEVs are impacting SMR requirements across the UK's fleet, finance and retail section. Dion Hanlon, Head of Commercial Vehicle and Motorcycle Valuations, who will update us on how the LCV market has performed since our last webinar. Craig Bridgman, Senior Current Car Valuations Editor, who will provide a detailed view of today's used car market. And finally, Chris Plum, Head of Current Car Valuations, who will round things off today, covering what's been happening in the forecast world, including the results from our latest sector review. As always, there'll be opportunity for Q&A at the end of the session via the button at the bottom of your screen. You're also welcome to email any questions to caphprwebinars@solera.com. Finally, today's session will be recorded and shared along with the slides with all attendees after the event. With that, I'll hand you over to Matt.
Thank you, Stacey. Good afternoon, everyone, and thank you for joining us today. So we're going to look at how battery electric vehicles, including new vehicles from Chinese brands, are reshaping service, maintenance and repair, or SMR, across fleet, finance and retail in the UK. This is an important topic because while electrification is now firmly mainstream, the industry narrative around SMR hasn't always been backed by real-world data. So what I want to do today is ground the conversation in actual SMR evidence, challenge a few assumptions around BEV cost advantages, and explore what this really means for fleets, finance providers, retailers. So let's start with a quick look at where the UK market is today. So after a volatile few years, as we all know, new car registrations passed the 2 million units mark again in 2025, and battery electric vehicles hit just over 23% market share. So electrification isn't really niche anymore. It's a core part of the market. And in particular, as we all know, it's driven by fleet. Fleet demand continues to lead BEV adoption, both because of tax incentives and the predictable renewal cycles. But crucially, we're now seeing significant volumes of BEVs entering that used marketplace, and that means SMR performance is becoming much more visible to a wider audience, and therefore much more important. And this slide highlights a really important dynamic. So we know around 4 in 5 of new BEVs are registered by fleets, but the balance changes obviously as the vehicles pass through their life cycle. And as company cars cycle off lease, they move into private ownership. And the result is that today, the BEV park is roughly evenly split between fleet and private users. Now, why does that matter? Well, first of all, private buyers are going to be sensitive to repair costs, downtime, and parts availability, as of course are fleets. An SMR may not affect the first owner in quite the same way, but therefore it is going to have an effect on residual values and remarketing performance. Now, we're often told that battery electric vehicles dramatically reduce SMR costs, and structurally that should be true. Battery electric vehicles have significantly fewer moving parts, they have no oil and exhaust filters, timing belts, exhaust systems, and they have much lower brake wear thanks to regenerative braking. And it's been reported that fleets have seen 20 to 40% reductions in SMR costs, and in particular brake wear reductions of 50 to 70%. But the key question, and the one we want to test now, is does this actually hold true using real-world data? And this is where real-world data comes in critical. So CAP HPI's SMR dataset, which covers 11 major European markets and is used extensively by leasing companies, OEMs, fleet management providers, dealers, warranty underwriters, etc. Importantly, this uses real-world SMR cost data, not just theoretical assumptions. And what it shows is that BEVs aren't really universally cheaper. Servicing and brakes are cheaper, but we see tyres wearing faster due to vehicle weight and heavy-footedness, sometimes by drivers, We see high voltage components, which are rare to fail, but are very expensive when they do. And we also see battery diagnostics, which is becoming an essential part of the used market as an on cost. If we look at our full data sets, looking at all the vehicles in the SMR data universe, BEVs do actually come out cheapest over a 3-year typical contract, but the margin is relatively small. It's about £100 cheaper than petrol and diesel, about just less than £40 cheaper than hybrid electric vehicles, although there is a good saving of about £500 when you look at plug-in hybrid vehicles. So they do have an advantage, but it's not a dramatic one compared to some of the other fuel types. If we break it down to the next stage, then we can see the real story. BEVs perform exactly as we expect on servicing and brake-related costs, but the tyres obviously are the big standout here. BEVs have significantly higher tyre costs than ICE vehicles or hybrids, and slightly more than plug-in hybrids. But interestingly, the other consumables category is almost identical across all fuel types, so there's no benefit there. So the idea that battery electric vehicles are eliminating all ongoing wear and tear costs isn't really supported by the data. And this leads nicely into why SMR competitiveness is now a strategic differentiator. Here, if we were looking at vehicles, we would expect to see a significantly higher cost. But we have to look at the other factors as well. One of those is that OEMs that perform well in SMR generally have strong parts availability and logistics, a well-developed approved repair network, responsive warranty handling, good access to technical and diagnostic data, and critically, predictable cost profiles. And this support ecosystem matters just as much as product engineering. We see Chinese brands now entering the market at real scale, and particularly in electric vehicles. And Chinese brands are now starting to supply into fleets in increasing volumes, which puts their SMR performance under scrutiny. What we see is the good news for the Chinese brands, perhaps, is that Chinese OEMs are competitive on some of those headline costs, in some cases outperforming the non-Chinese brands. But where the challenges remain are in infrastructure. We still have question marks. Parts availability is still maturing, some components can have longer lead times, and approved body shop and diagnostic networks are still scaling up. So the product may be competitive, but it's the ecosystem which is catching up. So let's summarize. What does this mean for fleet finance and retail? So if we look at fleets, rising SMR costs are going to squeeze fleet budgets. Parts inflation, labour shortages, longer lead times, they're all pushing up SMR costs, and fleets are having to rethink whole life cost models, especially for higher mileage vehicles. Budget predictability is thus becoming harder, and that affects procurement and replacement cycles. EV adoption is obviously also reshaping SMR strategies. Because EVs require generally less routine maintenance, that's a positive, but when something does go wrong, repairs can be more specialised and expensive, and fleets need access to EV qualified technicians and may face longer repair downtimes. SMR forecasting models now have to take account of that and also mixed ICE and EV fleets with very different cost bases. Longer vehicle downtime is going to impact productivity. Part shortages, workshop backlogs mean vehicles stay off the road longer. That's obviously going to affect schedules, service levels, driver productivity, important both for cars and also for LCV, of course. And many fleets are increasing their pool of spare vehicles or looking at using mobile repair services, etc., in order to mitigate that downtime. Data-driven SMR management is, of course, now essential. Telematics and predictive maintenance tools are not nice-to-haves, they're essentials. Fleets that use those real-time diagnostics can reduce breakdowns, optimize service intervals, extend vehicle life, and insurers also reward fleets that demonstrate proactive maintenance behaviour. And, of course, the driver. We have to improve driver behaviour and compliance. Poor driving habits, as I said, heavy-footedness, hard braking, speeding, overloading, can significantly increase SMR costs, and fleets are therefore investing more in driver training, behaviour monitoring, and incentive programs. Better compliance reduces wear and tear, improves safety, improves SMR. If we look at the implications for the finance sector, Some of these are the same. We expect rising parts and labor costs push up the cost of reconditioning vehicles at the end of contract, and that's going to affect residual values and residual value forecast accuracy, especially again for those higher mileage vehicles or vehicles that are poorly maintained. And finance companies have to take that into account when looking at RVs and maybe tightening condition standards to protect their margins. Poor SMR compliance drives up those end of contract charges. Missed services, non-OEM repairs can reduce resale value and increase refurb costs. Finance providers can face more disputes with customers over what constitutes fair wear and tear, and some lenders are responding by bundling SMR into monthly payments, etc., to try and manage that. EV SMR dynamics are changing the risk models. EVs, because they have fewer moving parts, as we said, and lower routine SMR costs, are still, as noted earlier, facing more expensive and more specialized repairs when they occur. Battery-related repairs and replacements can dramatically affect the value of the vehicle, and finance companies have to take that into account when making their SMR assumptions, particularly where they have a mixed ICE and EV portfolio. Workshop capacity issues, again, extending vehicle turnaround times, longer repair times mean it can take longer for a vehicle to be prepared for resale or auction. These delays this delay can mean cash conversion and is delayed and increases holding costs, while some finance companies are investing in preferred repair networks or even in-house reconditioning to maintain control over that. And again, there's also greater need for SMR data integration and predictive analysis. So finance companies like fleets starting to rely on telematics, digital service records, and predictive maintenance data so that their better SMR visibility can refine their RV positioning and reduce those unexpected costs and improve underwriting accuracy. Data-rich vehicles, particularly EVs, allow for that more dynamic pricing and risk management. And then finally, what about the retail sector, including used? Well, again, rising SMR costs potentially can affect retail prices, higher parts and labour costs, mean more cost for reconditioning used stock, and that can push up prices, particularly for older vehicles that may need more preparation. And margins can be squeezed unless retailers pass these on to their customers. Slow stock turns can, due to longer repair lead times, the result of workshop backlogs, delays in parts, etc., can mean cars take longer to prep for sale. Again, as we've said, slower stock turn ties up capital, reduces retailer agility, and that can be important in a fast-moving market. And again, some retailers are expanding their in-house ability to retain control over this. Condition variability can make valuations more complex. With SMR inflation, the gap can widen between a car considered clean and below when looking at used vehicles. And retailers can face greater risk when buying unseen or auction stock. So more retailers are looking at detailed digital inspections and again, looking at SMR forecasts in order to protect their margins. EV SMR uncertainty can obviously therefore affect used EV pricing. EVs needing less routine maintenance, but again, as we've said, the repairs can be costly and unpredictable, and so retailers have to factor in the potential for high-ticket SMR cost when looking at a used vehicle, and this contributes to the volatility that we've seen in the last few years. And finally, of course, we have the demand for ready-to-retail cars. That's something we've always had, but it's increasing and buyers are more sensitive to unexpected repair bills. They want assurances that's not going to happen. So retailers are able to offer cars with a full history, with strong warranties, bundled maintenance plans, etc., can build trust and make faster sales. Vehicles without those things obviously take longer to sell, require maybe some discounting. So let's wrap this up. There are three, I think, clear takeaways here. So first of all, BEVs do deliver that structurally lower cost, but not across every category, and it's not always as strong as one has thought. Chinese vehicles, including the BEVs, are competitive, but long-term success is going to depend on them building out their SMR infrastructure. And finally, the UK's overall SMR ecosystem needs to continue rapid investment in technician training, diagnostics, part logistics, etc., to support that transition at scale. So electrification is no longer the challenge, it's how we execute that. So thank you for your time. I'm very happy to take questions at the end of the session, particularly also if you're interested in the SMR data. But now I'll hand over to Dion.
Thanks, Matt. Hi, everyone. It's good to have you with us. As usual, I'll keep this fairly tight. I'm going to run through how new registrations have started the year, where BEVs sit within that. Then I'll move on to what we're seeing in used values, including seasonal context and the fuel split. So, starting with new registrations, this chart shows the cumulative new LCV registrations by month. January was a weaker start than last year, so it immediately put Q1 on the back foot. February was slightly different. On a single month basis, registrations were marginally higher than February last year. It's not a big swing, but it was an improvement. That said, when you add January and February together, we're still behind the same point that we were last year, and that's broadly the theme that we've been living with for a while now. If you take a step back from just the January and February data, the wider expectation hasn't really changed. The new market's still under pressure, and any improvement's likely to be gradual rather than sharp. A lot of that comes back to the same basics. Economic growth is weak, confidence is fragile, and capital costs are still high, which makes signing off a new LCV spend harder, especially for smaller operations. We're also seeing plenty of keep what we've got running for a bit longer behaviour. Even when the need is there, the decision often gets pushed out rather than replaced quickly. So slide 2 is the registration pictures with BEVs layered in. Using January and February, using the January and February period going back to 2018 through to the same point of this year of 2026, it's clear to see that while small, BEV volumes are still building, and year to date account for just over a tenth of total registrations in the data shown here, continuing the steady build that we've seen for the last couple of years. But it is worth separating the volume growth from what operators are actually feeling day to day. There's still a lot of uncertainty around EV transition, and that definitely affects replacement decisions. We've even heard cases where fleets that had moved to EVs have gone back to ICE at the next replacement cycle because the operational fleet just hasn't stacked up for them. It usually comes back to things like real world range, but that's becoming less of an issue, charging access, perceived downtime, and initial costs. And because LCVs are working assets, productivity and profitability tend to win. Where operators can still get what they need from ICE, it's understandable why they stick with it, especially in the used market where the decision is still very choice driven. Overall, BEV registrations are rising, with fleets doing most of the work, but the transition isn't even, and for some that means that replacement cycles will stay stretched, holding back wider fleet renewals. Moving on to the used market, this chart shows the month-on-month used LCV movements with plate uplift excluded. So into April, the average movement at 3 years and 60,000 miles was minus 1.2%, which takes the cumulative movement for 2026 to around 2% down overall. So yes, values have edged down, but the pace of the movement has still been pretty modest in the grand scheme of things. In fact, relative to recent years, it's been the best start to a year since 2021. And you could argue part of this is the market finally normalising after the pandemic. The question is whether it stays there, particularly with current energy price issues and wider uncertainty. There's also been a bit of chatter about extra volume possibly coming into the market in Q2. If that happens and if the mix is right, it could bring some additional downward pressure, particularly if the condition is poorer or if it lands in the wrong place at the wrong time. But the thing that hasn't changed is this. If new demand only grows slowly, then defleets and Part X volumes only grow slowly too. And that means that the used market is still running on relatively short supply of clean, well-maintained and late plate stock. And that shortage is the main thing that's supporting the market underneath all of the noise. The next slide is comparing 2026 movements against the seasonal average pattern, which excludes the COVID-affected years. Historically, the seasonal average would normally suggest larger negative movements through January, February, and March than what we've applied so far this year. So relative to seasonal norms, this values this year have softened less than you might typically expect at this stage. More broadly, the used LCV market is really generally pretty resilient. Demand is mostly business-led, not discretionary. So even in a weak economy, we still have to eventually replace vehicles to keep the UK moving. And when we look at what auction contacts are saying, the same themes are still coming through. Still remains short, bidding remains busy, and buyers are still paying up for the right vehicles. There's also a bit of a two-tier feel to the market. Reasonable condition stock for its age and mileage continues to sell well, whilst anything scruffy or needing work is harder to shift. Now, if we split the used car market by fuel type, the picture becomes less uniform. This chart shows month-on-month movements by petrol, electric, and diesel. And what is clear is that electric vehicles show a wider range of month-on-month movements than diesel, which has been more contained overall. This is exactly why we keep LCVs split by fuel rather than relying on one overall average. In practical terms, short supplies are likely to remain an issue for a while yet, especially for mainstream diesel stock that covers the widest range of real-world issues. So to wrap up, new LCV registrations have had a mixed start to 2026. February is slightly better year on year, but year to date we're still behind last year. BEV volumes continue to build gradually and still sit at just over a tenth of registrations year to date. But uncertainty around the transition is still influencing replacement behaviour. Used values have edged down, but movements so far have been modest and less negative than long-term seasonal averages would suggest. And fuel types obviously still matter, with EVs adjusting at a different pace to diesels. When you take a step back and look at it all as a whole, not a lot's shifted. Replacement cycles are longer, supply is tight, and used stock's still thin. Over time, you'd usually expect that type of imbalance to put upward pressure on used values, even if the movements in the short terms are a little bit mixed. That's it for me. Thanks for listening, and I'll pass over to Craig to pick up on cars.
Thanks, Dion. Good afternoon. I'm now going to run through what's been a busy first quarter for the used car market and brings things right up to date as we head into April. It's fair to say there's been plenty going on. This chart shows the actual cap live movements at 3-year 60,000 mile benchmark so far in 2026, shown by the black line and the dots, set against the long-term seasonal average highlighted by purple bars. That seasonal benchmark stretches all the way back to 2012 when we first introduced Cap Live. We deliberately excluded the two COVID impacted years as they significantly distort the underlying trend. Like many of our charts, this one runs from February through to the following January, with each point showing the movement from the previous month's Cap Live data. As we discussed in our first webinar of the year, February's movement landed very much in line with expectations, closely tracking the historical seasonal average. At that stage, it gave us some early confidence that, as we suggested back in January, the market would follow a fairly typical seasonal pattern throughout the months ahead. However, that hasn't quite played out. That's because both March and the most recent movement into April have come in behind the historical seasonal average at minus 0.8% and minus 1% respectively. So why are we seeing that? Let's unpack some of the key drivers behind the current market backdrop, starting with the remarketing world. Maybe one of the biggest factors we've seen so far this year, and we're only 3 months still in, has been the wholesale supply. In January, disposal data received into Cap HPI was up 6% year on year. Then in February, sold records were up 7% compared with February last year. What really stands out is that February volumes were higher than January, and in fact, even above what we saw back in February 2019. That's really unusual. Normally, as we head towards March, we'd expect to see supply tightening, and that often translates into a slight uptick in used values. That simply just didn't happen this year. Looking at March so far, sold records received into us are still tracking ahead of last year by around 5%. And while overall supply remains below pre-COVID levels, the trend is pretty clear. The direction of travel is up and supply is slowly continuing to build. But as ever, the devil is in the detail, and what we are seeing in the data is changing. As this chart shows, the share of sold data we receive into CAP HPI split by age. It runs from 2019 through to year-to-date 2026, and it really helps illustrate how the age mix of vehicles coming through wholesale have been shifting. Starting at the older end, vehicles 10 years and over, the purple section, but this makes up a much larger share than it did back in 2019. More recently, though, the share has been fairly consistent, which supports the wider theme we've talked about for some time now, an aging vehicle park. What's more interesting is what's happening at the younger end of the market. Vehicles up to 3-year-old now account for about 19% year to date, and that share has been steadily increasing since 2023. In fact, we're now close to the pre-pandemic share, which is a notable shift. That said, there's still a clear gap where retailers would ideally like more stock. The 3 to 5-year-old segment, those true retail vehicles, remain relatively constrained. We have seen a slight increase year to date, but supply here is still limited. Meanwhile, the 5 to 7-year age bracket is starting to trend lower, and this is important because this is the part of the market that's next in line to feel the impact of subdued new car registrations during the pandemic, alongside the supply chain disruption that followed. So while parts of the age profile are beginning to normalise, the legacy of the pandemic is still very much working its way through the system, and that imbalance continues to influence both supply in the wholesale market and the used car values as well. A big positive so far this year has been how well the market is absorbing this extra volume. For March, the average number of sale attempts needed to sell a vehicle at auction is sitting at around 1.5. That's a touch higher than February, but very much in line with where we started the year. At the same time, days in stock have continued to improve, easing back to around 8.3 days compared to 8.7 days back in February. Importantly, conversion rates have broadly held up, averaging between 70 and 80% so far this month. While that's slightly behind the same point last year, it remains ahead of pre-pandemic levels. Buyers are clearly being more selective, and there's still been enough demand to comfortably absorb the increased flow of vehicles coming through. In fact, as the months progressed, some auction partners have noted a modest lift in activity, particularly following the end of Ramadan. BEVs have continued to attract plenty of attention through wholesale channels, and once again we're seeing that contrast between trade and retail conditions. Retail demand has generally been more stable, while the wholesale environment has remained more changeable. Much of that volatility can be traced back to higher volumes returning to the market. At the moment, wholesale BEV supply is running at around 40% higher than this time last year. Demand is still evident. Many remarketers are reporting an increase in buyer numbers, but it hasn't grown quickly enough to absorb the extra supply, which has kept values under pressure. In response, we're seeing the shift in vendor behaviour. Some are becoming increasingly flexible on pricing, more are willing to sell below cap values in order to maintain conversions, particularly with the expectation that volumes may rise further in the near term. Buyers, however, are continuing to take the cautious approach. Concerns around future pricing movements and the risk of aging stock remain front of mind, even though retail conditions are still pointing towards steadier conditions. When you factor in the wider backdrop, higher fuel prices at the pump linked to ongoing tensions in the Gulf and the Middle East, short-term supply uncertainty, and expectations that electricity prices will ease from April, there's a growing argument for reassessing BEV stocking strategies. Recent price movements mean some models are now presenting stronger value at wholesale, and when framed around running cost savings and monthly affordability, this could be a timely opportunity for retailers. whether that's testing BEVs within your stock mix or increasing exposure where demand supports it. Looking ahead in the near term, many retailers remain well stocked, while competitive new car offers continue to influence buying behaviour. Additional volume from fleets and leasing returns, along with part exchange vehicles and the potential for increased pre-reg stock, are expected to feed back into the wholesale market over the coming weeks, creating some pressure that is typical for the time of year. Auction sites and storage compounds are also operating closer to capacity, which may introduce some logistical challenges as volumes build. As a result, conditions are expected to continue to ease as the market becomes more clearly buyer-led, although sentiment remains cautious but stable. Pricing discipline, stock quality, and broadly healthy conversion rates continue to underpin performance across much of the auction sector, albeit with the backdrop of the Easter half term, potentially making trading conditions a little bit more challenging in the short term. So let's move on to some of the key themes that we saw within the retail data and feedback from many of our retail partners. Feedback from the retail market continues to be mixed, with performance varying across different channels. Car supermarkets in particular have reported a stronger month, supported by good sales momentum and healthy stock turn. While overall profitability has remained supportive, this has been often driven by ancillary income and add-ons rather than the actual headline chassis margins. In many cases, stock levels are well aligned to demand, with buying largely focused on replacement and a clear emphasis on vehicles that can be prepared and retailed efficiently. Tracking average days to sell across our retail advert database, we've seen a steady improvement through Q1, following the rise at the end of 2025, with March currently tracking closer to 35 days. This improvement has been seen across all retailer types, with independents averaging around 47 days, while franchise dealers and supermarkets are closer to 31 days. Looking more broadly beyond automotive, consumer confidence has softened as March has progressed, with recent survey data pointing toward a renewed dip in household sentiment following the tentative improvement seen earlier this year. Measures from GfK and S&P Global continue to highlight growing caution around personal finances and the timing of larger purchasing decisions, driven by ongoing uncertainty around energy costs, inflation, and also interest rates. While base rates have been held, the lack of clarity around when cuts might follow has provided little in the way of a confidence boost. Spending hasn't fallen away sharply, but consumer behaviour has become more selective, with greater emphasis on being placed on value and monthly affordability. Feedback from our retail partners reflect this, with used cars that clearly represent value for money continuing to form best on forecourts. At the same time, many continue to comment around the highly competitive new car offers currently available, where low monthly payments, modest deposits, and attractive incentives can encourage buyers to switch from used to new. Building on that, we've compared a used PCP example for a 3-year-old mainstream SUV with around 26,000 miles currently advertised by a car supermarket against the cost of taking out a lease for a new hybrid version. While it's not a direct comparison, as we are looking at petrol to hybrid, both were run looking at a similar 3-year term at 12,000 miles per annum, with comparable deposits and assuming that the vehicles were handed back at the end of the term. On that basis, the used PCP works out at around £4,800 more expensive, or roughly £123 a month. While we fully appreciate that not all used buyers will consider new, it does highlight just how competitive the new car market has become over the past 12 months. With consumers increasingly driven by value and used APRs remaining high, this continues to create some risk of cannibalisation between used and new. While we try to keep as close a like-for-like comparison using the same model, the same exercise could easily be replicated across a number of brands and models. So overall, sentiment remains pragmatic rather than pessimistic. Stock levels are broadly under control, but trading conditions continue to demand discipline, with performance increasingly driven by buying accuracy, preparation efficiency, and a clear focus on values as the market moves into Q2. Some franchise retailers remain cautious around stock levels, particularly given the potential for increased pre-reg volumes, which can appear attractive on a cash basis, but are often harder to retail once financed on a monthly PCP. Here's a snapshot of the monthly movement summary as we moved from March into April. As mentioned earlier, values at the 3-year point declined by 1.2%, with all other age and mileage profiles recording broadly similar percentage reductions, and all sectors seeing values move back with the exception of coupe cabriolets. As highlighted earlier, BEV performance through wholesale channels remains a key area of volatility, with higher volumes, cautious bidding continuing to drive softer auction outcomes and reinforcing the disconnect with a more stable retail picture. At the 3-year point, BEV values have fallen by 3.6% or £670, with further declines of 2.6%, £810 at 1 year, and 4.3%, £590 at 5 years. By comparison, other fuel types have proved more resilient, with petrol the best performer at minus 0.6%, £121, followed by diesel and PHEVs at around minus 0.8%, and hybrids at minus 1.3%, underlining the extent to which BEVs continue to drive the headline market averages. Excluding BEVs, the average 3-year movement would be closer to minus 0.7. This helps underline the extent to which BEVs are currently influencing over the overall market movements, while also highlighting that other fuel types have, on the whole, performed more robustly. However, as BEV performance remains fragmented and the supply continues to grow, and with this fuel type increasing in share of the used market, comparing performance against historic seasonal patterns is becoming less straightforward. Finally, I'll just run through a few of the update slides we normally cover. 3 months into the year, the cumulative movement for a 3-year-old vehicle at 60,000 miles, including the plate lift and the red line, currently sits at 0.5%, making it the third weakest Q1 performance going back to 2015. Part of this reflects plate premiums becoming progressively shallower over time, something Dylan has highlighted in previous webinars, alongside a market that has proved a little softer than we initially expected. Looking at the cumulative movements over the past 12 months at 3-year point by fuel type, all fuel types are now in a state of deflation. However, the impact of the most recent BEV adjustments is particularly clear, with BEV values now down on average 12.4%, following on from a period of relative stability through the second half of last year. Taking a longer term view, 3-year-old BEVs have now fallen by close to 75% since September 2021, underlining the scale of the movement seen for this fuel type. Well, that's it from me. As you can see, there's been a lot going on and the market remains very multi-layered. We expect values at the 3-year point to continue to ease into April, with Easter often marking that natural turning point. Used supply is also likely to build further, driven by fleet returns and part exchange activity linked to the March plate change. While remarketers have remained relatively upbeat, stock levels and conversion rates are holding up well, but most now are expecting some softening in the weeks ahead. Chris, it's over to you.
Apologies, everyone. It looks like we're probably having a little bit of a technical problem with Chris.
Sorry, it's working now. See, that's what happens when you get me to stand in for Dylan. And I just want to say, great job there, Craig. You did much better than the usual bloke who normally does that. So As we're saying, a turn-up events, I'm stepping in for Dylan this afternoon and providing you with an update from the forecast team. And if you were on our last webinar, you might remember this slide where Dylan rather depressed all of us by talking through the potential black swan events, which, while unlikely over the next 12 months, could have a significant impact if they did materialise. Well, fast forward to today, and we're now facing a very real potential for global oil supply shock. The situation is changing almost daily, and it's still far from clear what the eventual outcome will be. BCA, not that BCA research, recently suggested that there was a 38% chance of a major oil supply shock this year. While that could clearly have wider economic implications, we've already seen some governments taking early steps to try and mitigate some of the potential effects. Even if the inflationary impact were to push the global economy into recession, the implications for used car values aren't necessarily negative. As we've discussed before, the majority of used car transactions remain needs-based purchases, and if it leads to a reduction in new car sales, there's also the potential for to support supply dynamics further down the line. So now there's no chance. So for now, there's no changes in our assumptions, although the forecast team will obviously be monitoring developments very closely over the coming months. With that, we can now move on to the impact of the SUV sector. This slide's taken directly from the editorial, and apologies to those who are already familiar with it, but we felt that it was worth including as SUV is such an important sector. Overall, the average change for the underlying forecasts was minus 4.4%, with a further 0.6% adjustment into the April book. That means the observed change between the March and April books averages out around about minus 5%. The primary driver behind this was the change to our future market deflation assumptions for SUVs. At 12 months, deflation increased by a further minus 0.5%, while at the 3 years, the overall change was closer to minus 3%. Some of this reflects the natural progression of used car volumes over time, but it's also driven by the continued growth in SUV volumes. By contrast, we didn't apply similar adjustments to convertibles, sports cars, or supercars in the previous month's sector review, as volumes in those sectors continue to decline. While the average reductions by sector and fuel type appear broadly similar, there is significant variation at an individual model level behind these averages. Some vehicles saw substantial forecast reductions due to the combination of weaker used car values since the last review and indications of ongoing softness. It's important to stress that it's not restricted just to electric vehicles. In a number of cases, including many electric models, retail demand remains relatively strong, and we made some small positive adjustments where the indications suggest that the trade market is likely to realign more realistically with retail over the coming weeks. That said, there's also models showing weakness in both trade and retail, and in those cases, more significant forecast reductions were applied. With that, we can move on to the overall market progression. And this is a slide you may well be familiar with also, although we haven't shown it on the webinar since September due to other topics we covered last time, particularly the budget. Values here are indexed back to June 2020, when dealerships reopened following the first lockdown. You can clearly see the impact of the record-breaking increases from 2021. More recently, movements have been much closer to the typical seasonality. Looking at the April book, values remain 26% above where we might expect them to have been following a more normal trajectory from the starting point, which assumes deflation of around 4% per year. Looking ahead to April 2027, we expect that favourability to reduce to around 23% above the June 2020 level, which by then would be almost 7 years in the past. So next, we're going to take a closer look what the next 12 months are likely to bring. And as Craig's already mentioned earlier, The used car market in March was weaker than we'd anticipated. We expected that softness to continue over the next couple of months, albeit not quite to the same extent. Some vehicles are likely to stabilise following recent reductions, particularly as volumes ease slightly. Electric vehicles are expected to underperform the market or the overall market, but I'll come back to that in a moment. Around the middle of the year, we expect movements to be closer to typical seasonality before a gradual deterioration versus seasonal norms towards the end of the year, mainly driven by an increase in volume again. As we've noted before, the traditional plate change months of March, September and January now tend to sit further away from the typical seasonality, reflecting the reduced premiums associated with new plates over this period of time. Again, many of you will be familiar with this chart. We're using the same starting point as before, but now splitting BEVs out as the orange line with petrol and diesel combined in the light blue. We saw cumulative used value reductions of around 70% for BEVs between September 22 and September 2024, followed by further declines that were slightly worse than the overall market, worse than the overall market through the middle of 2025. That then gave way to the period of relative stability towards the end of last year, with BEVs actually the best performing fuel type in the final months of 2025. Even allowing for this scale of axes, the movement from March into the April book around minus 3.5% is clearly visible. However, this feels very different to previous periods of BEV weakness. Historically, falling values were accompanied with softer retail demand, rising days in stock, lower conversion rates and repeated sales attempts. That isn't what we're seeing now. Instead, there's a clear disconnect between trade and retail. BEVs are still selling through wholesale channels, which suggests that at least part of the weakness is being driven by perhaps some vendor behaviour, potentially with auctions also playing a role in keeping vehicles moving. In our short-term forecast, electric models continue to be assessed individually. Overall, we still expect BEVs to underperform the wider market slightly, but not to the same extent as we've assumed in the last month. The last time we showed this slide on this webinar was back in November. Since then, there's been two changes to the vehicle baskets following the registration plate changes, increasing the number of comparable models that we can make from 68 to 82. At 12 months, the overall percentage difference has improved, largely due to the change in model mix between 2 to 4 years. Between 2 to 4 years, penalties are around 2 to 3% higher, while at 60 months, there's virtually no change. Only around 1 in 6 models now show a premium for BEVs over their ICE equivalents, and most of those are low volume models that are excluded from our averages. The key point here is that these penalties don't really make sense. Total cost of ownership benefits would normally imply a premium, yet our default forecast assumptions is that these penalties persist. In general, we struggle to see electric vehicles increasing in value, while at the same time ICE volumes are falling, and we don't expect those values to decline materially. So to summarise, we expect used values to perform slightly worse than normal over the next couple of months before moving back towards typical seasonality and then deteriorating again later in the year going into 2027. The outlook around the Middle East and oil supply remains highly uncertain. Even if we were to see a global recession, that isn't necessarily negative for used car values, particularly against a backdrop of subdued growth and flat household disposable incomes, where reductions in new car sales are more likely. We continue to see a significant disconnect between trade and retail for BEVs. This feels very different to previous periods of pressure, as it's if fuel prices remain elevated for the extended period, that could also provide meaningful support for used electric vehicle demand. That said, pressure remains on the nearly new market due to the ongoing new car discounting. Finally, it feels unlikely that VAT harmonisation for private and domestic charging is high on the government's agenda at the moment. There was, however, an interesting court case recently where Charge My Street successfully challenged HMRC, arguing that public charging should be classed as domestic for VAT purposes and therefore subject to 5% rather than the 20%. It now looks likely that we'll need to wait for the appeal processes to run its course before there's any further clarity. Anyway, that's it from me on the forecast side. I'll hand you back to Stacey for the Q&A.
Thanks, Chris. Thank you, everybody. And that concludes the presentations. We will open for questions. We've got just shy of 10 minutes, and there are already a few questions in, but please do use the button below if you want to ask anything. First questions are coming in from Matt. The SMR content was really interesting, Matt. First question from Joe Tanner. Do you have a feel for how much of the increased tyre cost for BEV is due to higher tyre wear, and how much is because of the more expensive EV specific tyres?
Thanks, Stacey. That's a really good question, Joe. I mean, some of it's a mixture, isn't it? And of course, it depends which car we're talking about, and the strategy of the manufacturer when choosing both tyres and wheel sizes. So we know that with electric vehicles, often the wheels have to be bigger, because if you put normal size, sort of 16, 17, 18-inch wheels on them, they wouldn't look right, because the cars are quite tall and they have a sort of high-waisted design because of the battery stack in the base. So sometimes it's a choice between putting tyres on that are quite large and the car looking a bit silly. And customers buy with their eyes; they buy for the look, and yeah, that's a trade-off that you have to make there. But it is also the case, of course, that electric cars tend to be heavier because they've got that battery stack in there. And whilst you don't have a big lump of an engine, you've still got weight distributed through the vehicle, and we know that that's causing a problem as well. It's something we're going to do some work on. We're going to look at the progression of tyres and wheel sizes. We're also going to look at the number of vehicles that are using low resistance tyres, particularly, again, trying to improve the range, because that's obviously generally a more expensive tyre. And then you've got the trade-off between, are you adding cost to the vehicle just for a few extra miles or kilometres in the range, which actually you probably shouldn't need to do. So it's something that we look at quite a lot. Shall I go to the second question, Stacey?
Yeah, please do, Matt.
Yeah. So this is a question from Charles Garfett about the servicing of these cars, particularly by used buyers. Obviously, a lot of them have to go to franchise repairers because we don't have that many independents that are capable of doing this. And this is just going to be a problem that is going to get potentially worse unless, as I said in the presentation, we have more investment across the board in supporting the electric vehicle environment. We need more people that are trained. We need more places that have the facility to service these vehicles. And obviously, I know the government is now talking about perhaps looking again at some of the targets, but we are supposed to be heading towards 50% electric vehicle new registrations for cars and slightly lower percentage for vans very, very soon. There's going to be a lot of these vehicles on the road, and we are going to need more and more of the facilities available to service them, or the cost is going to be high, and that is going to be a negative feature for a lot of used buyers, who of course tend to be more cost conscious perhaps than new buyers, although I think you can accept that new buyers obviously also are aware of the potential cost of maintaining a vehicle. So yeah, that is, I don't think it's going to improve, to be honest, unless we see some real investment in that area.
Thanks, Matt, for your answers there. Great topic. Another question in from Richard Lewis. Appreciate it's very early. However, do you have a point of view on the current petrol diesel inflation having an impact on the demand for new or used BEV or plug-in hybrid electric vehicles? I suppose that's for Chris and Craig.
Yeah, I think we covered off some of that within the presentation, but it is a good question. It's something that we're continuously being asked at the moment. I think logically we look at it and say that you'd imagine that there'd be some form of an uptick in consumer demand that hopefully could drive a little bit more positive picture from the retail side and then wholesale performance. But we haven't seen that of late. There's still a lot of volatility in a lot of the models that we are tracking from the wholesale performance, and some of that is being led by the volumes that we're seeing come through the market at the moment. So it's hard to really see. But I think anecdotally speaking to a few independents, especially who specialise in used EVs, they've all commented that the last couple of weekends have been quite busy for them. So they're having the need to go out and replenish. Hopefully we see that continue, because it might help with the current situation we're seeing in the decline in values. But I guess it depends how long the crisis goes on. There's lots of speculation in terms of Russian in fuel, etc. Well, some electricity, or at least electricity for the next 3 months, is coming down in price as of April. And some of the overnight rates I've seen on social media, a lot of BEV users, if they can charge at home, of course, are very happy because their overnight rates are dropping from about 7.5p to 5.5p. So if the going back to the SMR piece, if you factor TCO in as well, it does become a very compelling case for the used BEV, especially because of the price alignments that we've seen in the last month or two.
Thanks, Chris. Just a few minutes left. If anyone else wants to ask a question, please drop it into the Q&A. Dion, I've got a question in the inbox for you. BEV LCV volumes are building, but the transition feels uneven. What do you see as the biggest practical constraint right now? Charging access, range, payload, downtime, or cost?
The one that comes to mind immediately is always going to be range. However, as I said in the presentation, that is becoming less of an issue. It does depend on you qualifying that the vehicle is right for you in the first place. If you're planning on lugging loads of heavy things around in your vehicle, it's not going to get the range that was written on the tin, basically. So a lot of people are struggling with that. But where it has been qualified and you're only doing short distances and you've got the right size vehicle for the job that you need to do, then it definitely 100% works. And so then obviously range isn't an issue. But then after that, you'd go to capital cost because they are still very expensive.
Brilliant. Thanks, Dion. Haven't seen any more questions come in. We are just about at time, so I'd like to say thank you all. Thanks to our presenters, and thank you all for joining today's session, and we'll see you on the next one. Thank you. Bye.